Hey, Mohammed, can we go back to the banks? Because we were flashing some of those financial stocks, particularly some of the European banks, and they have come under even more pressure than earlier this morning. I think I saw Deutsche Bank down by about 8.8%, which is quite a bit weaker than it had been just about an hour ago. These banks, the story that we've kind of been following of this, and I don't know how much you know about this, is that all of these reports are out there saying that they've looked through a lot of the filings, the suspicious activity reports that the banks have filed, and basically say their banks have known that there was the potential for money laundering taking place. They filed all of these reports, and some organizations got a hold of some of those reports and now say the banks should have been doing more to prevent money laundering. The bank's response has been, look, the only reason you know about this is because we filed these reports and put that into the proper authorities. Where do you come down on this? Deutsche Bank down by 8.3% right now, HSBC down by about 5.8%, and those are some pretty significant declines.
Yeah, you already had a perfect storm going on for banks. Low interest rates, higher credit risk, and if you had a card business, less activity. Now, put on top of that renewed concern about regulatory and supervisory issues, and it literally is the perfect storm. And that's important because what has been helping banks so far has been wealth management and investment banking. That's what has kept banks going. And if you put a question mark over wealth management, then it's another headwind. So it really is an intensification of the perfect storm for banks right now.
What does this mean in terms of the broader implications for the markets if the financials are weak at this point, if they can't step in as much? Would that lead to bigger concerns for you about the ripple effects?
So what the market is looking for this to be a healthy correction, as opposed to something less constructive, is for the handoff to occur, for the rally to broaden, for banks, for lagging sectors to catch up. And if you put a question mark over one of these sectors, it just means it's a tougher road ahead. For what everybody wants is they want the rally to continue, but be a lot broader than what we have seen so far.
Yeah. In fact, the pullback, the biggest part of the pullback has come from a lot of those tech high flyers that led the way. I think if you look at Apple, it's down about 19% for the month of September. Big declines, 14, 15, 16%, I think, for Amazon and for some of these other big companies. Is it surprising to see the ones that came up so much be the ones that give back?
No, because they really did come up a lot. And they did have positive spillover. I think those who buy this is a healthy correction, a healthy pullback, which I don't, but those who buy it are saying that that's a good sign because leadership was being transferred from those who outperformed to the laggards. And if the laggards catch up, you provide more of a basis. I worry a lot more that for a long time, Becky, we have been powered by liquidity, by technicals, by liquidity conditioning. We have decoupled from fundamentals a long time ago. So fundamentals would not get the laggards to catch up. And you're seeing this on the banks today. It's going to be this falling in love again with the liquidity conditioning. That's what you need if you buy into this market at this stage. And that is all a conditioning issue. And I think what happened last Wednesday may end up being a lot more consequential than a lot of people realize right now, because the market should have gone up and stayed up because the Fed's surprised by being more dovish in its guidance than people expected.
Right.